Welcome everyone to Spaces with Bluejay. We do this on a weekly basis where we speak with other protocols to learn more about what they are doing and how they are bringing value to the space. And today we have Jacob, the co-founder of Clearpool Finance. Other than that, we'll let Jacob start answering some questions and let's get to know him and Clearpool a bit better. I guess to start off, Jacob, can you introduce yourself and also briefly what Clearpool Finance does?
Yeah, sure. So as you mentioned, I'm Jacob from Italy, and I'm one of the co-founders of Clearpool Finance. Clearpool Finance is a DeFi protocol for unsecured lending for institutions. It's built on Ethereum and also Polygon. So what does that mean? Probably everyone is familiar with the largest lending DeFi protocols, such as Aave, Compound, or Maker. So these were the first DeFi lending protocols, and the way they're working is they're working on the basis of over collateralization. So in the absence of any intermediary, as a lender, basically you can post collateral. And if you post collateral, usually you need to post more collateral than the actual loan that you're taking on. You're able to basically take on a loan without obtaining any credit rating. And this can be done completely trustless. And for lenders, this is obviously very safe, because if the collateral that someone is posting actually decreases in value, those protocols are automatically liquidating and the collateral, and you get your money back. These protocols work really well, but there was a problem with those protocols that they were very capital inefficient for borrowers. So we saw that there's a lot of borrowers in the market, a lot of firms, and they basically need to have access to liquidity. But for them, it doesn't really make sense to post more collateral than the actual loan they can take on. And this is where we saw a opportunity. We realized that there's a lot of firms in this space that are actually good credit. So they're relatively safe, but they do not have access to traditional financial funding. And this is where basically Clearpool came. So Clearpool, instead of collateral, Clearpool does a risk assessment, or we work with a third party that does a risk assessment. We do a KYC on the counterparties, and then we allow those counterparties to open liquidity pools that are unsecured. And those liquidity pools can then be funded by the DeFi ecosystem.
Nice. Yeah, that's a nice round of Clearpool. Yeah, thanks for introducing the initial styles. Crypto lending where it's over collateralized and how you guys are introducing under collateralized lending. And yeah, actually, Jacob, if you don't mind sharing more a bit about yourself, what were you doing prior to entering crypto and starting Clearpool?
Yeah, so I actually have a background from the startup space. So I used to be working with a company called Rocket Internet. It's a large German internet company incubator. And I was part of several large ventures, actually 2 ventures, where I was really helping to set up those ventures from the very beginning. And both of those ventures ultimately listed on the stock exchange. So those were consumer marketplaces like Foodpanda for the ones in Asia. It's the largest food delivery company in Asia outside of China. And then I went into fintech, alternative lending, with a company called Aspire, was one of the largest digital banks and alternative lending players in Southeast Asia. So we were doing all credit solutions for all sort of companies in Southeast Asia, like Indonesia, Thailand, Vietnam. So we would provide lending solutions for SMEs, for startups, for online marketplace sellers, basically everyone that was not served by the traditional banks, because maybe they were too small, or maybe they didn't have they weren't there around for several years already, so they didn't fulfill the criteria of the banks. It was actually then that I got more and more interested in DeFi. So personally, I'm involved in crypto since 2017, started investing in Bitcoin, but it was really the rise of DeFi in DeFi summer with the protocols that I mentioned previously, such as Aave and Compound, where I first saw that there's actual use cases for crypto. And that's when I started to get more and more involved. Also because I had this background in alternative lending, and I thought, okay, this is very interesting. And I believe that lending on chain is actually the future, and lending on chain is providing even more value, and it's even more innovative than what we've been doing in the fintech space so far.
Nice. And actually, yeah, when you mentioned Aspire, I did remember that on Goldfinch Finance, they actually do have a lending pool where Aspire, like the fintech credit fund, was getting funds from Goldfinch Finance for, I guess, their SMEs in Southeast Asia. But yeah, I really can see that your experience in Aspire really did inform you and inspire you to create Clearpool. And actually, I do also realize you have, like you mentioned, you were also in Food Panda and also saw Eatigo. I guess how did all those experiences also, I guess, help you out in getting towards being a founder of a company like Clearpool?
Yeah, thanks. I think definitely what helped me a lot was being part of several early stage, fast growing companies. I think during my time at Rocket Internet Food Panda, we really witnessed extremely fast growth and execution. And then obviously Aspire, I think, is very related to what we're doing at Clearpool. Obviously, currently at Clearpool, we are mainly working with trading firms, most of them crypto native. But we also with Clearpool, we are slowly looking at real world assets. So that's then really touching very much exactly the space that we were looking at Aspire. I think maybe just a note, I'm one of the 3 co-founders of Clearpool. Actually, my other 2 co-founders, my CEO Rob and my other co-founder Alessio, they both have a TradFi background, and they are actually the brainchilds, I would say, of this idea. So they used to work together at a bank. Rob spent his entire career in capital markets. Alessio worked together with him at the bank, and then he started off. He founded a crypto custodian called Hextrust, who's one of the largest digital asset custodian in Asia. And they were looking at this space, and they actually realized that there was a gap in the market. And I'm mentioning this so that I think altogether, the 3 of us as co-founders, we really much complement each other. So I have more of the startup background, that I was involved in several fast growing companies and in fintech, building something up from scratch. And they obviously have the real expertise coming from that TradFi backgrounds, especially Rob, who was basically working in capital markets his entire career. So I think overall, startup experience helps, but I think it's also important to really have a complementary team where everyone brings different strengths and different experiences. And I'm very grateful to have that and to have found them in order to start Clearpool. And I think overall we quite complement each other.
Nice. Yeah. Now we can see a bit of the whole picture. You bring in the startup experience on growing fast as well. And for them, they bring in sort of the fundamentals of what Clearpool is today. And yeah, I guess we can dive into Clearpool Finance. I guess as an individual retail investor, what can I do on Clearpool's page? Who can I lend to? What use can I expect?
Yeah, so as mentioned previously, Clearpool is a marketplace for unsecured liquidity, for institutional liquidity. So if you go on Clearpool, you basically see different types of borrowers. You can look at these different types of borrowers. There is some information on those borrowers. And there's also an indication of their credit score, which is not provided by Clearpool, but by a third party. And then as a lender, I can go onto Clearpool and I can choose whether I want to fund or whether I want to lend money to one of those borrowers. Now, what this opens up is the opportunity for basically any type of lender, whether this is someone small or whether this is a family office. They are in all parts of the world to actually have access to those type of lending opportunities that are otherwise only restricted to, I would say, firms that are experts in this market. And obviously, as I mentioned previously, usually in DeFi, the protocols are over collateralized, which is obviously very safe, but which yields relatively low yields. So currently the yields on over collateralized platforms are below 2% on stable coins. while on Clearpool, you'd be looking at around 10%. So the returns are higher and there is obviously more risk because it's unsecured, but basically you have access to high quality borrowers for higher risk adjusted returns.
Nice. Yeah. Yeah. Like you mentioned, I guess higher returns. When I go to the page now, I can see two lending pools, and one of which is able to even hit 21% and during these current market conditions. Yeah. How do you guys derive that kind of yields, which is really unheard of, especially during the current downturn? If I look at, let's say, what's that, those compound, yeah, more of the over collateralized lending pools.
Yeah, maybe just a quick note on how our pools are working. As Clearpool, we have a little bit of a different model that most of the other competitors out there. So most of the other competitors out there in the space that we are in, it's a secured lending space, they actually provide fixed term loans, meaning that there is a fixed loan size, a fixed interest rate, and a fixed tenor. So maybe you have a loan for 10% interest rate, 10 million loan for 90 days. For Clearpool, it's a little bit different. And we have these very dynamic pools that do not have fixed terms, but the interest rates of those pools actually determined by the utilization rate within a specific pool. And this utilization rate and this interest rate and also the pool size is then really determined purely by the market forces. So by supply and demand. So the size of the pool, as I mentioned, depends on how many lenders are actually depositing into that pool. And then the interest rate is then dependent by how much that particular borrower is utilizing of that pool. Now, the interest rate curves are designed in a way that they incentivize borrowers to utilize quite a significant portion of the pool. Right now, the interest rate curves are designed to incentivize roughly 85% of the pool. So at 85%, you'd have the lowest interest rate. This is because we do want the pools to be relatively efficient because the borrower only pays on utilized liquidity. So if the borrower is utilizing too little of that liquidity, the overall interest rate for lenders goes down. But at the same time, you want to leave some level of exit liquidity within the pool so that lenders can actually withdraw liquidity as well. So as I mentioned, at 85%, currently you have the lowest interest rates. The lowest interest rates right now at Clearpool are roughly 9.5%. If a borrower utilizes too little liquidity, so its utilization rate, let's say, go down to 50%, then the interest rate increases. So this is to compensate lenders for a borrower. This is to compensate lenders that a borrower doesn't really utilize enough. So borrower need to pay more and lenders are still getting a significant return. And then if a borrower is utilizing very much of the liquidity, then the interest rate shoots up again. And this is to, again, reward lenders in case that a utilization rate is very high and maybe there's not enough liquidity for lenders to take down. And it's also incentivizing borrowers to repay and bring the utilization level down. So this is the dynamic. These are the dynamics of the pool. And this is why the interest rate fluctuates. And I think currently in the moment, there's one borrower where, the utilization is higher. And this is why all the lenders in the pool are earning higher interest rate. We saw that this flexibility of the pools worked really well during times of market distress because it allows lenders to basically take out liquidity in case they're turning risk off. So due to recent events, when the FTX Alameda collapse happened, a lot of the lenders wanted to de-risk and they wanted to take out liquidity. And in those moments, we see that the pools can scale down relatively quickly, while once usually we see that the market stabilizes again and lenders are comfortable again to provide liquidity, we see that the liquidity pools or the Clearpool pools can scale up quite quickly. So this is exactly how the protocol works. And this is why Clearpool as a protocol has been growing very quickly, even during the bear market. But at the same time, we see that during time of market distress, the overall TVL can be reduced quite significantly, but usually we see it bounce back pretty quickly again. And this is in stark contrast to other lending platforms where, as I mentioned, there are fixed term loans. Very often we see that in those protocols, they work pretty well if the market is good and lenders are comfortable lending out. But the moment that lenders actually want to withdraw their liquidity, and there's a lot of lenders coming in and withdrawing their liquidity, as happened recently, very often these platforms fail in being able to actually allow lenders to take out funds. So yeah, we realized that when we designed Clearpool, it's a marketplace where on one hand you got lenders, and on the one hand you got borrowers. I think our protocol is very friendly for lenders simply because they have this possibility to take out liquidity at any point in time. But at the same time, we do see that even for borrowers, they benefit from this flexibility. They can withdraw more liquidity at any time, and they can also repay and close the pool at any point in time. So again, also, if you go on Clearpool right now, you'd see that there's quite a few pools that are currently at 0% utilization. And this is just because of recent market events when a lot of borrowers said they want to fully repay the loans. Then we expect those borrowers to start borrowing again in the coming weeks once the market has stabilized and they feel more comfortable again to take on loans.
Nice. Okay. So anyone can borrow their money, and the level of flexibility is available for both the borrower and the lender. And also yours, that interest rate curve is determined by the utilization.
Yeah, maybe just one comment also.
Yeah.
We have this very decentralized way of determining the rates of the curve. So these rates, they're not coming from the team or they're not coming from any outside rating agency, but our governance model, we call it the Clearpool Oracle system. Basically, as a token holder, as a C-Pool token holder, C-Pool is the native token of Clearpool. You can stake your C-Pool and you would delegate that C-Pool to Clearpool Oracles. So Clearpool Oracles are a combination of all Clearpool ecosystem players. So there's some borrowers, there's some lenders, and there's some neutral parties such as the rating agency or like custodians or lending players. And these oracles, they would vote on a regular basis. Currently, they're voting every 2 weeks on the parameters of the curve. So every 2 weeks, they vote where they think the interest rates would be. We would then take a distribution. We eliminate outliers and we take a weighted average of those votes. And that weighted average is then being implemented every new epoch, every 2 weeks. So basically, right now, every 2 weeks, the curve is adjusting based on the current market environment. So no surprise, yesterday, a new epoch started and the curve moved upwards, meaning the oracles defined that currently the rates should be higher than what they were a few weeks ago because there's additional risk due to the whole FTX Alameda situation.
I see. Yeah, and I guess you're touching on it as well. But before you get into FTX Alameda stuff, I guess we can also talk a bit about, okay, so currently, let's say as a retail investor, I can only deposit USDC, right? And with regards to, let's say, the rewards I get from the APY I receive, but is that purely in USDC or is there Clearpool tokens that I also get to earn as well?
Yeah, so I think most of the APY is USDC APY. So I think it's definitely real yield. There is a component, which is usually, however, relatively small. I think now currently on average, it's been like maybe 1 to 2% over the past couple of months. And this APR is paid in C-Pool rewards. We're quite conscious in using C-Pool rewards. We do believe that it can be beneficial, obviously, in growing a protocol. It is beneficial in also distributing basically like tokens to early users and adapters of the protocol. However, we believe that this should be used as a mean to achieve certain goals for the protocol, but ultimately the main and significant portion of the yield is an actual yield, which is the yield paid by the borrower. I think I saw on crypto Twitter a couple of times these days. I saw the quote, "If you don't know where the yield is coming from, you are the yield." And I think this is very spot on right now. This is very spot on what has happened during the recent bull market, where there's a lot of protocols that attracted users with completely fake yields, with all very, very creative tokenomics, but ultimately there was no real, there wasn't, the unit economics weren't strong enough and the protocol didn't actually create real yield. So obviously once the bear market hit, that wasn't sustainable anymore. And obviously some of those companies that offered this very unsustainable yield, not necessarily in DeFi, I think most of those, it died out, but in CeFi, this type of companies, very often this type of behavior led to fatal, I would say, crashes of certain companies that actually resulted in a lot of losses from the consumers.
Yeah, yeah. Thanks for touching on that. And yeah, definitely hashtag real you. So like you mentioned, most of the yield you get on Clearpool comes from USDC, and a portion comes from C pool tokens for distributing to early adopters. So yeah, thanks for clarifying on that. And everyone has a clearer idea on how the rewards go about. And going back to also, I guess you mentioned you have a third party that helps with assessing the credit risk of the borrower. I guess this is touching on the current centralization fears that some people have with regards to what happened with Alameda Research, which also had some lending pools in other, under lending protocols. Yeah, I guess if you don't mind to touch on that as well, how do you guys assess the credit risk of the borrower? Is there information available to the general public?
Yeah. So I think here, what is also important to say is that I think everyone needs to understand that if you are lending unsecured, there is higher risk associated with that. And again, this is the reason why yields are maybe 10% or potentially even higher versus below 2% in over collateralized protocols. So I think I really got to stress here that when you decide to lend unsecured, that there's always some counterparty risk involved, and there's always a risk involved that counterparty actually defaults. When it comes to Clearpool is actually Clearpool is a technology platform, and Clearpool is a marketplace. It's been really built in that way that as Clearpool, we do not allocate funds on behalf of lenders, but it's, as I mentioned before, it's like a marketplace where you have single borrower pools where borrowers are opening these liquidity pools, and then the lenders would come in and would fund those pools and can decide for themselves what sort of a portfolio of different borrower profiles they'd like to fund. We do facilitated decision making for lenders we have a partner, which is, however, third party. So it's not really clear, that is actually providing a credit score and a borrower capacity for every borrower on Clearpool, and they're called pre. So there is basically some indication on the credit worthiness of a borrower that enables lenders to better take that decision. And then we also see that a lot of the lenders are doing their own due diligence as well on those counterparties. And we think that Credora has a very powerful solution and is really at the forefront of this particular sector, the credit risk evaluation sector. And maybe just quickly what they're doing and what is special about Credora is that in addition to just looking at static documents such as financials, so usually most, I would say, also C5 players, they're just looking at the financials and then doing some due diligence, looking at what is there. Do they have any on-chain credit history? So did they borrow and repay on any other DeFi protocols? So next to just doing this financial statement analysis and doing this due diligence, they have the capability to actually do this real-time risk assessment. So real-time risk assessment, how that works is that as a borrower, they are providing the read-only API keys from all the different trading venues that they're operating on. So they would provide the API keys of their Binance accounts or all other exchanges, or if they're using any custodians, as well as DeFi wallets that they're using. By providing that data, Credora is actually able to see in real time big data. So how many assets do they have across all the different exchanges, and even an indication of whether they are actually market risk neutral, what sort of beta they're trading on, what sort of delta they're trading on. And this is quite powerful because this basically gives them a real-time view under the hood. In case any of those indicator is deteriorating, this will be noted real-time. And this is why the credit rating on Clearpool, or the credit rating by Credora, is also adjusting in real time based on the actual figures and based on actual data coming from those trading firms. So yeah, I think we're very happy with this partnership, and we think that this is overall a very good solution that combines both traditional risk assessment and basically this new real-time risk assessment that we think it's necessary in a world like crypto, where things can change very quickly, and having access to data from a few months ago might not be sufficient in order to evaluate properly.
Yeah, I agree. Glad that there's on-chain and real-time credit assessment available with Credora as well. And like you mentioned, the risks we take this is obviously an under-collateralized loan. So the risk is higher, and hence the higher yields. And Clearpool is just a marketplace for it. I guess most of the risk is to be bear upon the investors themselves, who have to do their own due diligence before providing capital to these lending pools. And yeah, I guess also on that note, how do you guys, how do people approach you how do people find out about Clearpool Finance and I guess start borrowing money there? Do you guys do the outreach, or do those market makers and trading firms just approach you?
Yeah, so I think it's a combination, right? Again, just to note here, we are only working with institutions on the borrowing side. So as an individual, you can't just open a borrowing pool on Clearpool. It's a combination, right? At the beginning, obviously it was us, our team, reaching out to all the different borrowers, pitching them, trying to convince them to open a pool on Clearpool. I think once we gained certain traction, we received a lot of inbound requests from borrowers. And yeah, very interestingly, I think we see not just I would say the crypto native market makers that you'd see right now on the platform, but we received a lot of interest from more traditional profiles. So some of the largest firms on Wall Street, some of those trading firms, they're very interested to borrow on Clearpool, but also different fintechs or other protocols. So we really see quite a diverse pool of borrowers that are interested to open loans on Clearpool, and we were quite excited to actually look at this. I think right now the team is still very involved when it comes to onboarding different borrowers, but we're actually working on making this process fully decentralized. So as a borrower can just come make a proposal to the community, and then the community decides whether a borrower is able to open a pool. Yeah.
Nice. And yeah, I guess other than that, can you also share more on, how do you guys approach those? You mentioned earlier you're moving more towards real asset lending versus institutional crypto trading firms. Yeah, how do you guys do that shift? And are they reaching out to you, or is this your kind of active outreach to get them on board?
Yeah, so when we looked at building Clearpool, I think it was clear from the beginning that we did not just want to provide a lending platform for trading firms, but we wanted to build a platform that caters to all types of companies. And the trading firms are basically just the first ones, because we thought that they are we still think they're interesting counterparty. That being said, we still realize that there is a lot of growth potential catering to the companies that we're currently serving. Those trading firms, they're gonna, I think for the foreseeable future, they're definitely gonna still be the main borrowers on the Clearpool platform. And yes, as I mentioned, I think did a pretty good job in onboarding a lot of the crypto native trading firms, but there is a lot of interest from some of the more traditional players. And that is per se a different type of category nearly, and is it represents a huge potential for Clearpool. Now, other than that, we also by talking to some of our main lenders, we do realize that some of them are interested in different types of borrowers, and we think that we also want to serve different types of borrowers. So right now we are looking into different borrower categories and working also on onboarding a few of those. Here, this ranges from types of like miners to potentially even other DeFi protocols, all the way to, as I mentioned, real world assets like fintechs. Personally, or not personally, as a company, we think that especially in the current market environment, we see that there's definitely there's a lot of demand, there's a lot of interest for not crypto related exposure. And this is why we think that fintechs are very interesting. Here you would work with the likes of my previous company, as I mentioned, or other type of players that are serving all areas in the lending space. This could be the real estate, mortgage space. This could be like invoice financing, inventory financing. There's a lot of opportunity there. And obviously this is a huge market that there's a couple of companies already looking at this, but we overall believe that in general, DeFi lending is at its very early stage and the opportunity is huge for whoever who's actually succeeding in finding a solution that really caters to all these different companies.
Nice. And you're basically including the whole range of loans across different industries. And yeah, I guess we can't wait for that future because currently it's really nascent. You mentioned majority of the protocols are still doing over collateralized, and a lot of the under collateralized lending protocols are still on crypto trading firms. So yeah, there's much room to grow in terms of types of loans that we reach out for. And yeah, other than that, I'm just curious with regards to investor protection. Are there also crypto insurance available for individuals who use Clearpool's lending pools?
So currently there's no real counterparty insurance. So like full counterparty insurance, that's something that's not yet there, although we are talking to a few players for such type of solution. What we are also looking to introduce is protocol insurance. So insurance against protocol risk, against any potential hacks, etc. There is, what we do have on Clearpool is there is a sort of, we call it an insurance pool. So part of the revenue is actually going into an insurance pool that will be available to LPs, to lenders in the event of a default. But yeah, as of now, when it comes to DeFi insurance as well, this is mainly being focused right now on protocol insurance. There has been DPEC insurance. I think that was quite relevant and interesting when the whole Luna UST incident happened. But yeah, I think having a actual counterparty insurance is something that will be very relevant. And we're actually discussing with a few players to potentially offer this in the future. But as of now, there is no such thing as having a full counterparty insurance.
Yeah, I understand. Yeah, it's good to know that there's already an insurance fund that's building up as well. And yeah, that's definitely going to make users feel a bit more safe while using these lending pools. Other than that, yeah, curious with regards to the profile of your lenders. Do you guys have any understanding of where most of them are coming from? Are there more institutions which are lending their money on Clearpool, or is it more retail investors?
Yeah, it's a combination. As I mentioned, borrowers are all institutions, lenders. It's a combination. Technically, everyone can access our permissionless pools. So we have two types of pools. We've got the permissionless ones where everyone who has like a regular MetaMask wallet can just connect and fund those pools. And then we have a few permissioned. We have a product that is permission pool, where basically we KYC both the borrower and the lender. And those pools, the one that we had, I think now both are closed, but those pools were only accessible by whitelisted lenders, and those were all institutions and professional investors. As I mentioned, right now, it's definitely a combination. We got some larger lending players, crypto VCs, hedge funds, family offices, whales, and then obviously we also got some retail investors that are part of this. I think Clearpool has always been, especially initially, relatively institutional. When we only were on Ethereum, with the introduction of our Polygon pools, I think Clearpool definitely became a lot more interesting as well for more like retail investors, like people with smaller check sizes. And we are currently building a couple of interesting products. Mainly we're looking at, for example, like thematic pool. As a lender, you don't need to choose and pick all the different borrowers, but you can just provide liquidity into a index pool, and that index pool allocates to all the different borrower pools. And we think that the introduction of products like these is going to bring more retail users, just going to make it more appealing to a broader audience, not just retail, but it's also, I would say, family offices that are potentially less knowledgeable about those counterparts. And we believe that having such a more diversified solution is going to open access to those guys. Yeah.
Yeah, lovely. Definitely aggregate pools where I guess an individual can access thematic pools or more of an index kind of lending pool. That's definitely good, especially when, like you mentioned earlier, the risk is higher when we go for these type of products. But in the case of an aggregation of lending pools, it might be lower risk, so a bit more enticing to end user as well. And yeah, I guess I'm more or less done with most of my questions. Just to let everyone in Twitter Spaces know, if you guys have any questions for Clearpool with regards to what they are doing and their product or anything that's coming up, you can ask, and you can request to speak to us, or you can either tweet at us as well. And yeah, we'll get to your questions. And yeah, I'm down to my last two questions. So Jacob, with regards to Clearpool Finance, I guess what developments can we expect in the next year besides bring on more real asset lending pools? And where do you see crypto going in the next year, 1 to 3 years as well? I know there's a bit of a packed question, but just your personal opinion would do.
Yes, I think that the second question is, where do I see crypto going in the next 1 to 3 years? I think it's obviously very hard days for crypto right now. But personally, I've never been more excited to be in DeFi as of right now. I'm just thinking of what has happened throughout this year, but especially the last couple of weeks, is really what I think crypto has been trying to avoid with decentralization. Once again, problems that came and everything that happened was all coming from centralized players, and it was all caused by misconduct of some of those parties and genuinely just a lack of transparency. And I think here is where the industry just went completely wrong, and it actually was really not in the spirit of crypto and decentralization what actually happened. Once again, if you look at DeFi, obviously DeFi adoption went lower, but decentralized platforms overall worked really well throughout this crisis. And this is why I do believe strongly that obviously in the short term, we are all hurt, and it might be still painful for a couple of weeks, months, but in the medium term and definitely long term, everything that has happened represents a strong bull case for DeFi, for more transparency and visibility into what's happening. So I don't necessarily think that everything is moving towards DeFi, even though I think DeFi is going to capture a larger market share. I think that many of the CeFi players will just have to adopt some of those DeFi functionalities, right? We are at a point where nobody trusts anyone anymore, and there's a good reason for that. So the only real way out here is to provide more transparency, having everything on chain, and for lending players to actually have every single whole loan book on chain and visible to everyone. I think that is a first positive step into the right direction. And I think or I hope that in a few years, or maybe in 1 year, we're going to look back at this time and we hopefully can see that there has been some positive consequences coming out of this whole market crash. I also think that permission DeFi will become more mainstream as well. So as I mentioned, we already have those pools where we basically combine some of the elements of real DeFi, which is like transparency and the ease of doing loans, more efficiencies and lower costs, with maybe some elements from the traditional finance world, such as KYC, KYB. I think if that is being done in a privacy preserving way via, for example, zero knowledge proof technology, I think that can also be beneficial. And I do think that is also where the market and where DeFi is going to. So I think there's going to be more there's still full DeFi and there's permission DeFi. I think permission DeFi is also going to increase in traction. As I mentioned before as well, I like the saying, if you don't know where the yield is coming from, you are the yield. Definitely, I would wish that there is less of a focus on speculative and creative token models and more focus on some protocols that are actually solving for real needs and that are actually proper revenue generating businesses. And I think that's another thing. So I think probably the times where we can just launch a protocol where the business model is not really clearly defined, where the revenue is not really clearly defined, but the returns are mainly just coming from a speculative token model. Those days, I would say, are over as well. So overall, I would hope that DeFi is just getting more mature, growing up. And I think in a couple of years, there will be a lot of developments and we'll have come a far way in this space. As for Clearpool, your first question, again, we feel that right now we really just have to build the premise where you just really have built a first product where we, I think already achieved good product market fit. But based on this, we actually have we have a very ambitious roadmap. I mentioned there's a couple of interesting products that are coming out. So next to our regular permissionless pools, we actually are building and launching soon a permission product, a more sophisticated permissioned product that's going to allow access to more traditional players in this field. And then we're also going to launch a couple of other products, such as those thematic pools that I just mentioned, and maybe a couple of other products as well. For us, we really want to build this decentralized capital market ecosystem. So we built Clearpool with the idea of it being very composable. And on top of this composable single borrower pools that we have right now, you will see a lot of new products that are going to be launched over the next year. So I think we have a very extensive product roadmap. And I think we've been also mentioning a few of those new products that we're planning on in some of our Medium articles. So I'm not going to go into a lot of details, but yeah, we really feel that we're just at the very beginning of what we actually want to build.
Hey, Jacob, I actually have a question on my side. Good to see you and thanks for coming on the spaces. So, one of the things I was wondering is you talked about real world assets, lending to like fintechs that are not correlated with the crypto markets as being one of the strategies for growth. I'm wondering, like, what do you see as some of the challenges with scaling here, right? I think there's still quite a bit if you look at some of the existing players that have like off-chain operations for this. But I was wondering what your thoughts are on what's going to take this to like the size of a couple hundreds of billions in size instead of the place where it's at today.
Yeah, so I think in terms of real world assets, there's definitely a few challenges. And one of those challenges is just if those players have access to regular financing, maybe very often they would prefer that simply because there's less friction involved. So there's no on and off ramping. It's maybe clearer from a regulatory perspective. So I think in order to really enable real world asset lending on chain, the solutions need to be better than what the current off-chain solution offer. So I think that's key. Otherwise, obviously, I would say in a bull market, you can always you can probably gain traction for all sort of lending solutions simply because maybe the token incentives represent a significant portion of the yield. So there'll always be a lot of interest. I think now that the market changed, you really need to have a product that is superior and caters to certain lenders so that they basically need to use this product versus just doing this off chain. I think one of the things I'm most excited about, and one of the biggest strengths of DeFi is the composability. So I think while right now, if you are actually lending to real world, if you're lending to fintechs currently via all sort of other solutions, it is usually something that requires you to lock up capital for a longer period of time. I think with DeFi, you actually have the possibility to make this more dynamic and make this more liquid. And I think if you're able to achieve that, then there's going to be demand for those type of real world asset lending solutions.
Gotcha. No, makes a lot of sense.
So yeah, basically it's not enough just to put a lending relationship on chain, but you really gotta innovate and make it better than what the off-chain world is currently offering.
Nice. Yeah. Thank you, Jacob, again. And yeah, as I mentioned earlier, for the audience, if you guys have any questions, you guys can request to speak or just tweet at us or at Jacob the questions. And yeah, once again, thank you, Jacob, for joining us on Twitter Spaces and getting us to learn a lot more about Clearpool and yeah, how you guys are bringing institutional crypto lending adoption, to crypto. And yeah, I guess we give everyone a bit more time before we end it off. If they have any questions at all. And I guess the most interesting thing I've learned today was with regards to you guys bringing up thematic and index lending pools. So we got one question. Yeah, Alex, you can unmute and ask your questions. Yeah, now I can hear
Great.
you loud and clear.
Yeah, first of all, really love the protocol. I love how it works. Definitely showcased how the interest rates go up and down based on the utilization, all of these things. In the beginning, obviously, everybody gets nervous when the util rates go up and nobody knows like when you go through it the first time. So I think like from a functionality perspective, it's really one of the better lending protocols out there. What I was wondering is that given this whole circumstance with FTX and what we're seeing in general is basically the same core issue all around DeFi, is like the rehypothecation, the giving loans or multiple time using same level collaterals and things of that nature. Is there anything that you have maybe by now developed as takeaways or better measures to avoid traps like that? Or maybe Credora, obviously, who's doing the risk classification on your behalf or for us, I guess, as users too. Anything in that direction that you may comment on?
Yeah, I think the biggest lesson of this year for everyone is just that you realize that nobody is too big to fail in this market. And I don't know if we didn't have, for example, like a loan with 3AC directly, but they were, I think, borrowers, especially the large ones, especially the ones with the best reputation, they could borrow significant amounts without being very transparent. In the case of 3AC, they didn't even provide proper financials, and this was being accepted.
We all know this one-pager document, right? Kyle
Yeah.
state I have billions of dollars.
Exactly. NAV, exactly. And this was accepted by the industry. And that's a very extreme example. But I think overall, there has been a little bit of a tendency of a lot of players not having to really be very transparent. And this is, I think, the biggest learning, that no matter who it is, as lenders or in general, as platforms or as rating agencies, you really need to make sure that you're actually getting maximum transparency and you're actually seeing the full picture of exactly what's happening. And there, we as a protocol, Credora here in this case, became a lot more strict as well, I think, over the last year or so, even more. And it's just, there's just a significant push towards more transparency. I think there was already a good progress since what has happened with 3AC. We see that probably that's not enough and that transparency needs to go further. It was initially obviously also just mainly focused on those counterparties. Now you realize that there's additional type of risk that maybe was mispriced or underestimated by some, which is the risk of exchanges. Obviously now also for exchanges, there's a lot of pressure towards more transparency and for them to actually make their assets visible at any point in time. So I think just overall, the whole industry is learning that what has been done so far and what has been asked so far is probably not enough. We all need to become a lot more rigorous in getting maximum transparency, and only for the players who provide maximum transparency, you should actually give out certain loans.
I agree. Thank you.
So if you don't see it, you shouldn't believe it. And I think that's the same for exchanges, right? If an exchange can't,
100%.
then,
I couldn't agree more. Like, since we can, let's just say, don't trust, verify, like a lot of things can be proven on chain, or at least, let's just say, if a market maker takes a loan and they use those funds to market make on, say, FTX, Binance, whatever, wherever they do it, that at least Credora should have visibility or access, knowing borrower is in shape to pay back when needed. And not, obviously, FTX died in a day. That was very tough to think of. How could have we avoided that, given that there was no transparency about FTX? If you hear about the whole case now that there are no financial records, they were all using messengers that delete messages. But also, I guess we all have to look for our own mistakes, is that basically anyone and everyone just trusted them. And that's completely the opposite of the ethos of decentralized finance and blockchain transparency. And especially as an uncollateralized lender, that's your biggest risk, right? And so whatever we can do to improve on that end, I think will massively benefit the ability also for much larger capital to flow in that space.
yeah, no, I 100% agree. 100% agree. And this is why I think I mentioned before, I think even the centralized guys would need to adapt some features of what's happening in DeFi. And I think that's already happening a little bit with exchanges, even though it's not yet ideal, but there needs to be a strong push towards that. And I think that's already like a big improvement. Full decentralization is still going to take a lot of time, I think, but we're working towards that. But already having assets visible, loans visible on chain for everyone to look in, and not just having to trust blindly someone because everyone thinks they're great. That should be the biggest lesson.
Yeah, because what we learned is that the ones that had the best reputation turned out to be the biggest can of worms. And that should be like a big lesson, really.
Yeah,
everyone is. Thank you, and keep on. I really like what you do, guys. Unfortunately, right now is not the best time to allocate capital, but I'm sure going to come back sooner than later.
Thanks a lot. Thanks a lot for the feedback.
Thanks, Alex, for the timely question. And we definitely need to be more careful during this period of time. And yeah, I guess if there's no more questions from the audience, we'll wrap it up here. Thanks again, Jacob, for your time. They educated us about Clearpool finance and how you guys are gonna build under collateralized lending in the crypto space into a wider ecosystem. And that's more or less it. Thank you, Jacob. And
Thanks a lot for having me.
Yeah.
Thanks everyone. Thanks everyone who tuned in. And if you have any questions, feel free to ping me on Twitter and I'd be happy to answer them.
Great.
Wish everyone a nice day. Good night for the ones in Asia. All right.
Yeah. Good morning, good afternoon, and good night to everyone.
And let's hope for better times. All right.
Definitely.
Okay.
I can't wait. But take care.
Thank
Bye-bye.
you.